Welcome to this week's edition of Reverse Mortgage Weekly, where we go over the reverse mortgage program, dispel myths, speak the truth, and tell everyone about the good, the bad, the ugly about this wonderful program that has been helping thousands and thousands of seniors live a comfortable retirement. And really, what is so special about the reverse mortgage is the peace of mind that people feel when they are able to complete these and know that their financial situation is at hand. Let me give you an example. A lot of folks, one of the reasons they take these out is that they have a mortgage payment that they're currently paying. So let's say you have a $1,500 mortgage payment that you have, principal and interest, and you decided you just wanted to retire, and now inflation is happening and you're running short on cash every month. Well, one of the things that we've seen with some of our clients is that they're taking from their life savings so that they can pay that $1,500 and live comfortably every single month. And that's just not a desirable thing to do, because how long is that going to last for, taking from your life savings? Your life savings becomes your crown jewel after retirement, because we don't know how long you're going to need it. You could live to 60, to 70, to 80, to 90, to 100. Well, the difference between 70 and 100 is 30 years. So your nest egg may have to last you 30 more years than you might have realized. So to get your cash flow under control in retirement is such a vitally important part of a healthy retirement plan. And basically, with a reverse mortgage, you can take that $1,500 payment, convert it into a payment optional program, and then at that point, you don't have to worry about coming out of pocket for that $1,500. Now, if you want to make the payment, if you want to come out of $1,500 out of pocket, you can. You can treat the reverse mortgage just like any other loan. But the caveat is that you're not forced to make that payment. And 99.9% of folks look at making those mortgage payments as maybe not the wisest decision to do in retirement. And there's a few reasons. So long and short of it, you change that $1,500 into a optional payment type program, and now you've got an extra $1,500 a month to play with. But the reason a lot of folks look at that monthly payment in retirement is not being a wise decision, because if you do make a monthly payment, a monthly mortgage payment in retirement, you have to take it from one of two buckets. That's really the options we have. You can take it from the first bucket, which could be your income, which maybe is a little bit more limited than it has been, especially in retirement, when you're living off Social Security, fixed income. The other bucket you're taking it from is your life savings. And again, if it were up to me, none of my clients would ever have to take it from their life savings, because that's really your crown jewel. That's something you want to try to keep liquid and stay liquid as long as possible. And that's the thing about having equity, is it's great to have equity, but it's a lot like having a glass coffee table full of cash right there in the middle of your living room that you can't get to. And that's the problem with equity, is it's not liquid. We can't take a picture of our house, go down to the grocery store and show them a picture of our house and pay for our groceries. It doesn't work that way. So basically, putting yourself in a position to basically leverage your home for victory in retirement is vitally important. Another reason people don't like to make that mortgage payment is that most of it's going to interest anyways, especially if you just refinanced, because 50% of the interest on a reverse mortgage, on a conventional 30-year fixed plain vanilla loan, 50% of the interest is paid in the first 10 years. It's really a bad deal from the consumer, but we just deal with it as consumers. We don't, it's just, that's what we got. So, that's what we do. So let's go ahead and get into the presentation here. So my name is Zach Smith. I own Chariot Financial. I've been in the mortgage and real estate industry for over 21 years. And I own Chariot Financial. I've worked for a lot of big banks, Chase, Fairway Mortgage, Cherry Creek Mortgage. Pulte Homes. But I went off on my own and opened my own brokerage in 2019. It's probably the best decision I ever made. So what are we going to go over in this presentation? Well, we're going to go over what a reverse mortgage is and what you've heard versus reality. Why do they exist? How do we qualify potential borrowers? And also, what do they look like in the long term? So what a reverse mortgage is? Well, there's a lot of common misconceptions about the reverse mortgage. The first misconception is that it's a government takeover of your home, that it's a scam, it's hard to sell your property, you'll go upside down on your home, you'll lose title to your home, or you'll leave your kids with a lot of debt. None of this is true. All of these are false, and it's a little strange that people still, well, I think that there's a sentiment out there and that there's a really large conglomeration of folks who just don't really understand the program. So they look at this, and one of the main things people don't like about this program is there's an upfront mortgage insurance premium. So it's pretty hefty fee. Now, it doesn't come out of pocket. And if your home appreciates 2% year over year, it pays for itself. But at the closing table, it's pretty big fee. It's 2% of the property value. So if you have a $500,000 home, they're going to charge you 10 grand at closing. They're going to roll it into the note. And people look at that and say, oh, gosh, it's a bad deal. The reverse mortgage is ripping off old people. But the problem is that that's not just a reverse mortgage thing. That is an FHA thing. So, for instance, we have programs that are not FHA programs that you don't have to make that fee, that your closing costs are just the same as it would be on any other loan. So, but a lot of people don't understand that. They don't know it, and they look at that, oh, it's a bad deal, don't do it, So, but these are the biggest misconceptions that I have seen over the years. Number one, it's a government takeover of your home. This couldn't be further from the truth. The government doesn't want to take over your home. They don't want to own your home. They don't want title to your home. It's a big problem for banks and governments to own real estate. It is a big problem for them to own residential real estate because it becomes a burden to them. So they don't want, it's not a government takeover of your home. Now, is the government involved? Yes, it is an FHA loan. So the government does have some involvement in these loans, but they're mainly for your protection. The next thing that I hear is that it's a scam, to take possession of your home and that the bank wants your home. The bank doesn't want your home. Again, owning real estate for the bank is not a good idea because it's not something, they don't want illiquid assets. They would rather charge us 30% on a credit card and get money from us that way than to own our real estate and sell it. It's a big problem for them if they sell it. The upfront mortgage insurance is based on FHA, not reverse loans. So we just kind of went over that. Yes, it's a hefty fee that's assessed, but it's not something that's, only for reverse mortgages. It's an FHA thing. So first-time home buyers, people a year or two out of bankruptcy, FHA is really friendly to those two types of borrowers. And do they charge them? Yes, they charge them 1.75% of the loan amount. So you're still getting an upfront mortgage insurance premium charge, but when you see it on a reverse mortgage, it's discriminatory. But when you see it on a regular mortgage, it's nothing. There's no uproar about it. So, but the fact is, it's the same thing. Negative amortization moves at a very slow pace. So, folks think that you're going to go upside down. If you go upside down on a reverse mortgage, guess who loses in that scenario? The bank. The bank loses in that scenario. So keep that in mind. They don't want you to go upside down. They don't want you to own your property. It doesn't work for them. They have way better ways to make money than sell your real estate. So just keep in mind that that's just a silly notion. You do need to pay your own taxes and insurance. If you don't pay your taxes on your home, there's a possibility someone could put a tax lien on the property, and that could be problematic for people. But, the thing is that people will say, well, that's a bad deal, the reverse mortgage, if you don't pay your taxes. Well, it's a bad deal for any mortgage. You got to pay your property taxes, even if you don't own a mortgage, even if you don't have a mortgage, it's a big deal. So it's not just for the reverse mortgage. You have to pay your property taxes. There's two guarantees in life, right? And also, you want to shop around when you're choosing someone to work with on your reverse mortgage. Just like car mechanics and insurance people and babysitters, we're not all made the same. There's different folks who have different values when it comes to originating these loans, and I would recommend that you shop and find somebody that you work with really well. It's hard to sell your property is another thing that I hear, which is completely false. It's no different selling your property than it would be if you had a 30-year fixed. No different at all. We order a payoff and basically pay it off. You'll go upside down. Again, this is something that I hear, and this is just, this one is probably the silliest one that I've heard, because if you go upside down on these, the bank just lost. The bank does not want to own collateral that they can't get their money's back worth out of it. It doesn't make any sense for them. Do you think the banks wake up every morning in their conference room and say, you know what, folks, all their top executives there, and they're in their real hardcore meeting. Let's figure out how we can give money away today. Who wants to raise your hand if you want to give money away today? Boy, I don't know where you bank, but I do. My bank doesn't do that. My bank figures out how can we make more money off of Zach today. One of the ways is credit cards, But if they own a property and it's worth more than what you owe on it, or you owe more than what it's worth, the banks are not in the business of buying high and selling short. That's just not how they operate. They're only going to originate. We're only going to be able to get you approved if they think, if the risk factor, if they're taking a risk, but they want that equity to outlive you. They don't want the loan to increase so high that they can't sell it for what it's worth. That would be not a very good position for the banks or for FHA. So this one just does not make any sense. So you will lose title to the home is another one that I hear. Again, it's just nonsense. You still own the property. It's yours. You don't give it up to anybody. It is your home and you own it. Last one is you leave debt to your kids. This is a non-recourse loan. So, you're never going to owe more on the property than what it's worth. So those are some of the things that we see a lot, or that I have seen over the years when it comes to the reverse mortgage and people just not being educated about it. Let's go into some of the things that a reverse mortgage is. So a reverse mortgage is a loan. Surprise, surprise, surprise. It's a loan. So you do have to pay it back. But it's the only loan that's due the day after you leave the house. So what I mean by that is that you have to pay it back if you pass, if you no longer live in the property because you get transferred to a facility, or if it's no longer your primary residence. If you jump ship and go to Costa Rica and never come back, well, they're going to ask you to pay that loan back by selling the property or having one of your family members refinance it out of that. Now, it does have monthly payments. There's a big group here a couple of years ago that got in trouble from the Federal Trade Commission because they're out there with their celebrity sponsors telling everybody, hey, we're going to eliminate your mortgage payment. You don't have to pay a mortgage anymore. Well, there is not a required payment on the reverse mortgage, but that's a little bit misleading because they're still going to charge you interest on the amount that you haven't paid down. So you still technically have a mortgage payment on a reverse mortgage. It's just that it's optional. If you want to make it and your balance would never go up, you'd never have negative amortization, you can do that. Or you can basically let it ride, which is what most people do, what I plan on doing, just so you know. This is part of my financial plan. As soon as I'm eligible for a reverse mortgage, I'm running down to the bank to get one. So one of the reasons is that fact right there is that you don't have to make a monthly payment, which, I know as a lender that if I'm making a 30-year mortgage payment on a 30-year note, if I'm making a mortgage payment on that, boy, that's a raw deal for me because 50% of the interest is being paid up front. in the first 10 years. For example, if you have a $600,000 note at 6.125%, your principal and interest payment is $3,600 a month. Guess how much of that is going to paying off your loan? $600. The other $3,000, guess where that's going? That's going right into the shareholder's pocketbook, going right to keep those offices nice and shiny. So to me, it doesn't make any sense to help the bank prosper when I can take the money I'd normally be paying on a mortgage payment, put it in my pocket. So one of the reasons why I do these every week is I really, truly, in my heart of hearts, want people to know that this is a great benefit to them. It's a brilliant way to leverage your home. Again, it's like qualifying. There is an income assessment, but the risk factor is completely different than it would be on a normal mortgage. So it's much easier to qualify for these. The biggest deciding factors is your age and the equity in the home. You know, when you have a normal, average, everyday 30-year fixed loan, you walk into the bank and say, hey, I want to borrow $400,000. First thing they say, oh yeah, we're happy to help you. Well, how are you going to pay us back? So they're going to pull your income, they're going to look at your assets, and they're going to look at your credit. And then they're going to pass judgment on you as to what kind of risk you are. They're going to say, oh, well, this person's got good credit, a lot of money in the bank, and makes good income, low risk. This person's got bad credit, no money in the bank, doesn't make a lot of money, high risk. So with that, the risk assessment is completely different on a reverse mortgage, because if you're not making a monthly payment or you're not required to, how do you assess the risk? Well, again, it's going to be time, because they don't want you to go upside down. They want to make sure if you are alive for another 30 years that this loan is not going to balloon to the point where they can't get their money back. So time and also the property value are the risk assessments. You do have to pay your taxes and insurance separately. Now, we can set it up to where we pay it with the mortgage. Most people choose not to do that, but that is an option that we can do. But for most people, they are paid separately. We also have FHA and proprietary programs. So a lot of folks think, when they think of the reverse mortgage, they're only thinking about the HECM loan. That is FHA's version of the reverse mortgage, which you have to be 62 or better to qualify for those. On the proprietary programs, you only have to be 55 to qualify for those. So why are these so popular right now? Over 500,000 people in the United States have a reverse mortgage, about 480,000. Well, number one is cash flow. Reduced income in retirement creates a crunch for retirees. Rising healthcare costs, inflation. The list goes on and on why folks are getting squeezed right now. Well, increasing your cash flow in retirement or creating a sense of passive income is incredible and can help people retire with grace and dignity. Also, people are on a fixed income, inflation. And, the thing about a lot of folks right now is they do have a lot of equity. And, again, equity is great to have, but it's a lot like having that glass coffee table right there in the middle of your living room full of cash that you can't get to. So, you sit down on the couch and turn on the TV and you're watching your favorite show and you put your feet up on the coffee table. Oh, look at all that cash. Look at all that cash. That's great. Well, if the car goes out or you want to take a trip around the world, or maybe somebody wants to sign up for that cruise that's going to be leaving for 4 years and not come back for another 4 years, sign me up. Sign me up. But if you wanted to do that and you are looking for the cash to do that, and you have all this cash sitting in front of you, like, how do you bridge the gap? How do you get into that coffee table full of cash? You got the cash to do it. But in order to get to that cash, you got to sell your property. And then that begs the question, where do you go? So being able to access that cash without a monthly payment is key for this program. That's the number one reason why people love this program, is peace of mind. you're able to create a financial safety net or to pay off your existing loan and convert it into a payment optional program. But increasing that cash flow in retirement, you can breathe. You can breathe again. So how can older adults access equity with a reverse mortgage? Well, combination of the following. You can do a lump sum, which is basically you can do that for a purchase or refinance. They just show up with a suitcase full of cash. No, I'm just kidding. They wire the funds into your account. You can set up a line of credit, and that's where a lot of my clients, they tend to really like the line of credit because it does create somewhat of a financial safety net for you, and it does grow over time on the amount that you don't use. Now, there's also monthly proceed payments as well. There's a tenured payment and term payment as well, that people can basically turn your house into an annuity, and it pays you back each month. So let's talk a little bit about equity. So what is equity? Well, equity is cash that you can use that is not accessible unless you sell or take out a loan or pay it back with interest. So again, you can access all that cash in a coffee table, but you got to sell the property to do it. It's a lot like, again, it's not like, I love using that analogy, as you probably have wondered. I probably said it about 18 times already, but it is a lot like having a glass coffee table with cash in there that you can't get to. So does it benefit you in retirement? Does your equity benefit you in retirement? No, not at all. Why? Because it's not liquid. Again, we can't take a picture of the house and go down to the grocery store and buy your groceries with it. It doesn't do anything for you in retirement. It basically just sits there. Is it better to pass on a higher net worth or more equity? Now, that's the real question I think people should ask themselves, because this is the thing. Most people and most retirees, what they do is they position themselves to basically run through their liquid assets first, their retirement fund. And if you've saved enough and you got enough, that's great. But all the statistics say that Americans are not saving enough for retirement, especially if we lose Social Security. So we're not saving enough. And those of us who are saving are just not saving enough. So being able to, what most people end up doing is running through their entire life savings, and then they end up having to sell the house to survive. Well, what most people are not looking at, which there's been a lot of studies about this to say this is actually the best approach, is to actually take from your equity first. Open up that line of credit on a reverse mortgage and withdraw from that instead of withdrawing from your retirement accounts. And guess what happens? Well, the survivability rate of your assets goes up exponentially when you do that, mainly because of compounding interest and how it works. And we'll go into a little bit detail about that as well. But does cash do better in my pocket or locking it up in the home? Again, I always think cash is better in my pocket because then I can direct it. Then I can spend it on what I want. I can invest it in what I want. Whereas if it's in the house, you don't have any access to it. It's just part of the house at that point. So let's talk a little bit about the three buckets of finance. So you see you have this first bucket, which is your income bucket. Second bucket is your savings bucket. And the third bucket is your home equity. So most of our days pre-retirement are spent with this income bucket going into savings and then also going to pay off the property. Well, these buckets change quite a bit after retirement, mainly because the pre-retirement, the first bucket, as you can see, it shrinks. It gets reduced, and we're not making as much as we normally would have made in retirement. The second bucket, the yellow bucket, becomes very important, mainly because we don't know how long we're going to need it. So it does have its own throne there because that really becomes your crown jewel. And the fourth bucket, again, is just kind of sitting there. It's not really doing anything for you. There's equity in there. You know you have it. But again, it's like that glass coffee table that you know you have all that cash. You just can't get to it. Well, that's all we have for you today. I hope you enjoyed our short presentation. If you have any questions for me or you would like to reach out and get a free estimate, you can reach me any time of day, 24/7, at chariotreverst.com, chariotreverst.com. You can also reach me at zpsmith.com as well. Well, thank you so much for your time. I hope everybody has a great day, and we'll catch you next time. Thanks a lot. See you next time.